Hello and thank you for downloading HR ListenIn, the free monthly podcast from the employment team at international law firm Taylor Vinters. Subscribe via iTunes or download via the Taylor Vinters website or YouTube channel. We hope you enjoy the show. Hello and welcome to the latest episode of HR ListenIn. I'm Dom Holmes, an employment lawyer at Taylor Vinters and presenter of HR ListenIn. On 6th of April this year, new legislation comes into force which requires larger employers to report on the gender pay gap within their workforces. So we thought we would use this month's podcast to focus on some of the key principles, some of the trickier issues which are likely to cause some headaches, at least initially, and some practical steps. Joining me to discuss this topic in more detail is my fellow Taylor Vinters employment lawyer, Scott Glacken. Welcome back, Scott.
Thanks, Dom. Hi, everyone.
Now, Scott, you and I have done quite a lot of work together on this already, having hosted HR forum seminars in London and Cambridge on this very subject. And there were some interesting insights from some of the attendees.
Yes, that's right. I think it seems pretty clear that employers who are caught by the regulations, or at least those on the cusp of being caught, are at various stages of planning the first wave of reporting, which needs to take place by April next year. It's a complex topic which will raise different issues for employers depending on the makeup of the workforce, I think. And the main concerns seem to be, firstly, determining which individuals you have to report on, bearing in mind the different ways in which businesses manage long and short-term resourcing requirements. And secondly, how on earth do you go about calculating everyone's pay, given the variety of ways in which employers incentivize staff? The principles look relatively straightforward at first glance, I think, but if you look closer, there's quite a bit of maths to grapple with.
Well, we'll come on to that shortly, and I should make clear that this will be a brief overview only. We could potentially talk about it for hours, but I suspect it wouldn't make the most riveting podcast, so we'll keep it to our usual 20 minutes or so.
So, Dom, perhaps we should start by setting a little bit of context.
Sure, and I guess the honest assessment is that on average, men get paid more than women. And there are various potential explanations for this, perhaps historic, perhaps reflective of the gender split at various levels within the workforce, or perhaps because some types of work have traditionally been done by one sex rather than the other. I think the reasons will vary across organisations, but the gender pay gap certainly does exist.
But it's not consistent across various age ranges, is it?
No, certainly not. And the gap is relatively small at early stages of careers, and in fact, women in their 20s are often paid slightly more than men of the same age. However, from about the age of 40 onwards, which is normally when people move up the career ladder into more senior roles, the gap widens quite considerably. Why is this? Quite probably it has much to do with childcare. Women have maternity leave, they may take extended career breaks to bring up children, they may return to a different organisation where their peers have since overtaken them in their absence. And also more women than men work part-time.
So how does gender pay gap reporting differ from equal pay protection, which has been around since the 70s?
Well, you're right. Equal pay is also intended to tackle disparities in pay between men and women. However, equal pay claims tend to be costly, complex, quite time-consuming, and actually they only address a specific type of problem. Equal pay protection is very individualised. At its most basic level, it is essentially a woman comparing herself to a man who does similar specific work and demanding the same pay for it. Gender pay gap reporting is intended to provide a more comprehensive overview across the whole workforce.
And it's fair to say that gender pay gap reporting is only part of the picture.
Yes, and there are other initiatives around to ensure that female workers have fair access to career progression. At executive level, the Davies report has set ambitious targets to redress the balance and ensure a higher proportion of women in the boardroom. And more recently, you may have read about returnships. Now, these are structured work experience programs run by some organisations as a way of easing mothers back to work following a career break. There was quite an interesting article in the Times on it recently, which I've tweeted, and you can find it on my Twitter feed at DomHolmes147.
So let's move on to talk about some of the basic principles. The concept of gender pay gap reporting is pretty simple in itself. A relevant employer must publish gender pay gap information in relation to its employees for 2017 and each subsequent year.
Well, that's pretty simple to get to grips with, but as we both know, Scott, the devil is in the detail here. And if you break down the actual process of gender pay gap reporting from raw data to final report, I think the most concise way we have found of doing it involves a 40-step process. So there is complexity and it will be time consuming, but it is important.
Yeah, that's right. And most important of all, do not lose sight of the very basics, I think. Every year, a relevant employer has to publish gender pay gap information in relation to his employees. That's it.
Okay, so let's break that down a little bit. We have relevant employers, we have employees, and we have gender pay gap information. If we take each of those three in turn, what is a relevant employer, first of all?
So, first and foremost, the duty to report gender pay gap information only applies to employers with 250 or more employees on the 5th of April in the relevant year. 5th of April is known as the snapshot date, and for public sector employees, 31st March is used instead. Now, importantly, individual corporate entities are treated separately for this purpose. So let's think about a holding company with 2 subsidiaries. Each subsidiary employs 200 people, meaning the group employs 400 in total. Neither of these companies are subject to the reporting requirements because no legal entity employs more than the 250 employee threshold. The fact that there are more than 250 employees across the entire group is actually irrelevant.
And when you talk about having 250 or more employees, what do you mean by that?
That is where it gets interesting, I think, Dom. So I'm sure we all know what an employee is, right? Well, an employee for one purpose is not always an employee for another purpose. So gender pay gap reporting obligations derive from the Equality Act, which means that employee has a wider meaning than, say, the one that applies for unfair dismissal purposes. So it will include individuals who perform under a contract of employment or apprenticeship, so pretty straightforward there, but also individuals who perform work under a contract personally to do work, but who are not in business on their own account.
So as you say, Scott, the first category, contract of employment or apprenticeship, pretty straightforward, but I suspect it's that second category that will give rise to a bit more confusion.
Yes, people who perform work personally other than for customers or clients of their own business are known as workers. We had a good discussion in last month's podcast about worker status and how wide that definition is. So the starting point is that anyone with worker status is included for the purposes of reporting and for determining if you hit the 250 employee threshold.
Okay, Scott, so give us a few examples of who might be caught within this wider definition of employee.
So the most obvious example is consultants who provide services personally, and that's even if they're not on the payroll and classed as self-employed for tax purposes. But there are lots of grey areas that have come out in recent discussions we've had with businesses. For example, those on 0 hours contracts may well be caught. Also, what about gig economy workers such as Uber drivers and Deliveroo riders, or those listed on a bank of workers who are simply called upon as and when needed from a central pool, potentially all caught by the gender pay gap reporting requirements, I think.
What about overseas workers?
Yes, employees may also include workers based overseas if they have a closer connection with Great Britain than any other jurisdiction. But it does not include any agency workers, as the agency worker is responsible for the reporting requirements here. And it also doesn't include partners or LLP members.
Okay, so given all of these grey areas, how should businesses approach the requirements in practice?
Well, there might well be a broader consideration here. Many companies engage individuals under consultancy agreements as self-employed contractors, but in reality they look a lot like workers. So if you're not treating these individuals as workers for other purposes, for example by paying them holiday pay and sick pay, etc., then you might think twice before including them in your gender pay gap information. And we'll talk a little bit about the risks of non-compliance a bit later on.
Okay, so we know what a relevant employer is, and as far as we can, we know what an employee might look like. What about the gender pay gap information that needs to be provided?
So the minimum requirement is to publish 2 sets of statistics. The first category relates to bonus pay and applies to all employees. So an employer must publish the difference in mean bonus pay in the last 12 months, the difference in median bonus pay in the last 12 months, and also the proportion of male and female employees receiving a bonus payment in the last 12 months.
So just to be clear on that, the requirement to report on bonus pay is retrospective. It looks at bonuses paid during the previous 12 months ending on that snapshot date, so 5th of April for private sector employers.
Yes, that's right. So for the first set of statistics relating to 2017, employers need to collate data on bonus pay for the period 6 April 2016 to the 5th of April 2017. And the analysis focuses on when bonus is actually paid rather than when it's earned.
Okay, so that's bonus pay. What about that second set of statistics?
So this relates to hourly pay. Importantly, the employer only needs to include what are known as full pay employees. So they can exclude anyone who receives reduced or zero pay during the 5th April pay period as a result of, for example, maternity leave or sickness absence. And this is to ensure that the figures are not skewed by absentees who are paid less than their normal rate of pay.
And are those hourly pay statistics similar to those for bonus pay?
Only up to a point, I think. Again, there are 3 statistics to calculate. Like bonus pay, you need to report on the difference in both mean and median hourly pay, not by reference to the previous 12 months though, but in relation to the relevant pay period. And the relevant pay period is the normal pay period in which the 5th of April falls. So if you pay an employee monthly, it may well be 1st of April to 30th April. Of course, that may differ if you have consultants who invoice on a different basis or you pay certain staff weekly, for example.
Okay, so we've got the difference in mean and the difference in median hourly pay between men and women. What about that third statistic?
So the final piece of the jigsaw for hourly pay reporting is to show the proportion of male and female employees in each quartile pay band. So you list the employees in order from lowest to highest hourly pay, and then you divide into 4 equal groups or quartiles.
I guess it's probably worth mentioning as well that calculating each individual's bonus pay and hourly pay is not a straightforward exercise. We won't get into too much detail here, but if anyone would like a copy of the presentation we gave at our HR Forum event, we would be very happy to oblige on that. For current purposes, it's probably enough to say that bonus pay will include most forms of incentive that are not classed as ordinary pay, so that's performance-related bonuses, commission, and share incentives such as options or deferred interests in securities. Rather strangely, recruitment and retention bonuses count as ordinary pay, so they're not deemed bonus pay for these purposes. Now, ordinary pay includes things like basic salary, allowances and shift premiums, but not non-cash incentives such as private medical insurance. And overtime is excluded from the gender pay gap reporting regime altogether, as are termination and redundancy payments.
Yes, that's right, but calculating someone's hourly pay can be a particularly complex exercise, I think.
Yes, absolutely, because you need to try and create a meaningful comparison of pay, when the reality is that people may work variable hours or receive variable amounts of pay, including bonus pay, during that April pay period you're looking at. So accordingly, adjustments may need to be made to ensure that the analysis is as accurate as it can be. There's a step-by-step calculation that actually needs to be approached quite methodically for each employee.
Yes, and I think, again, that's a level of maths which is probably beyond the scope of our discussion today.
Okay, so once we've collected the data and done the calculations, we're left with some statistics. What do employers actually do with that information, Scott?
Well, they need to publish it, so both on their own website for a minimum of 3 years, and also on a government website which has been specifically set up for this purpose. The publication needs to take place within 12 months of the snapshot date, so for private sector employers the first deadline is the 4th of April 2018. For the public sector it will be slightly earlier, 30th March 2018. Now, the statistics also need to be accompanied by a written statement confirming the accuracy of the information, signed by a prescribed person in the regulations. So for a private limited company, that will be a director. For other types of organisation, it will be someone at a similar level of seniority.
And I guess perhaps the most important bit for employers is the opportunity to include a voluntary narrative.
Yes, exactly. So when you publish on your website, the regulations give you the option to include an explanatory narrative. And this can be really useful to provide some context and colour around what appears to be a basic set of numbers. So let's look at an example, say a specialist construction firm, a typically male-dominated industry. The majority of your employees are male construction workers. The few female employees you have work in office-based roles, maybe receptionists, HR, maybe secretarial roles. The specialist construction workers are highly paid. The office staff are not as well paid. So taking this hypothetical scenario, based on the raw statistics, there's a large gender pay gap in favour of men, which may, on the face of it, look like female employees are treated unfairly.
But of course, statistics do not tell the whole story.
Of course, that's right. This is where you can use the narrative to explain the situation. You can explain the nature of the industry and the reason why the figures are the way that they are. You could even go as far as explaining the steps that you've taken or are planning to take to reduce the gap, for example by encouraging female construction workers. All of this will help to avoid employee relations issues, I think, as some staff are bound to read the reports. And also it will help to address any wider reputational issues. And it's also worth mentioning, I think, that there is some pretty good guidance from ACAS out there, which is available online. This will be a handy reference source for you as you go through the process, and it includes some quite good work examples as well.
So you mentioned there that you can use the narrative to explain what you have done or what you are doing to address any gender pay gap concerns. What kind of steps should employers be considering?
Well, it will depend on the nature of the business and the nature of the issue. As a starting point, a gender pay gap does not necessarily mean there is a problem. There may be a perfectly reasonable explanation for it, which does not require drastic remedial action. However, there are various things that employers might want to consider. So good family-friendly policies and flexible working arrangements that encourage retention of female workers are high up on the list. And if managed correctly, these can provide significant benefits for employers that outweigh any associated costs. Similarly, consider whether those who make pay decisions might need training on gender pay or equality issues to reduce the risk of conscious or even unconscious bias.
And presumably what you have to say in the narrative may actually impact on the timing of when you publish your report.
Yes, definitely. If there are things that can be done to reduce the gender pay gap, it's better to know sooner rather than later. So I would suggest that employers do the calculations relatively early on. They then have the chance to identify and work on any areas for improvement, which can be explained in the narrative. Remember, there's a 12-month window for publishing the data. So you could look at producing additional statistics as well that better reflect the reality. The legislation sets out the minimum requirements, but there is nothing to prevent employers doing additional analysis, of course. And equally, if you have a good news story to tell about gender equality, then you can get the message out there early.
Well, thanks, Scott. I mean, it's fair to say that we've only really scratched the surface of this topic, but hopefully that has given our listeners a good grounding in the basics and some of the potential problem areas. My sense is that the regime will be difficult to get to grips with for the first year or so, But once employers have good systems in place to collate the data and perform those calculations, hopefully it should run relatively smoothly.
Yes, I'd be surprised actually if payroll software is not developed in the next few years that makes this a lot easier. I understand that the Government Equalities Office is already looking at some prototype testing.
I think that's right, yes. And before we go though, we should mention what happens if employers do not comply.
Yes, well, there are currently no financial penalties for non-compliance, so employers will not be fined. However, the government will keep this under review and may still name and shame. So on the face of it, that may seem like the legislation is pretty toothless, but there are some good reasons to comply. For example, it may not look good if your competitors all publish a report and you don't.
I agree, and I think there are also some very positive reasons outside pure compliance for taking the time to do this exercise. For example, the data can be used to shape an employer's future HR strategy, and it may mean that employers are better informed of the dynamics within the workforce. It may highlight a disparity, for example, that they didn't know they had, which is purely inadvertent, but which may be holding back certain talented individuals.
And I think there's also plenty of external value to be gained here. There's an opportunity to use gender pay gap reporting to deliver a positive message to the market, to competitors and to potential future recruits, especially through the accompanying narrative to be provided with the figures.
Yes, I think the narrative is really key there. I would be amazed if any business has a zero gender pay gap. So it is a chance to explain what action is being taken and to accentuate the positives. As is always the case with stats, context is everything. Well, thanks, Scott, for being my co-presenter again this month. It's been a really interesting discussion.
Thanks, Dom.
And if you, our listeners, have any views you would like to share, we would welcome hearing from you. Scott and I are well versed in gender pay gap issues, and the wider Taylor Vinters employment team is also on hand to help with the trickier areas of gender pay gap reporting, or in putting in place your narrative or HR strategy once you've run the numbers. Simply get in touch with your regular Taylor Vinters contact, or if you're new to our firm, you can contact me at dominic.holmes@taylorvinters.com.
Or you can contact me at scott.glacken@taylorvinters.com. And don't forget to subscribe for free via iTunes if you can, so you don't miss out on future episodes. Just search for Taylor Vinters on the iTunes store.
In our next podcast, I'll be joined by my colleague Alex Bees to discuss social media in the employment law context, and in particular, the use of business platforms such as LinkedIn. How do you protect your client connections and confidential information when employees with LinkedIn accounts leave your business? Join us next time to find out more. You can access all previous editions of this podcast via iTunes, the Taylor Vinters YouTube channel, or by clicking on the ListenIn icon on our homepage, where there are direct links to the web pages of all the presenters. For those of you who are active on social media, you can also find me on LinkedIn and on Twitter at DomHolmes147. Thank you for listening in to HR ListenIn.